It's the 15th anniversary of the GLD, the world's most traded gold-backed ETF, and the companies behind its inception are ringing the closing bell at the New York Stock Exchange on Wednesday. Joining me today is one half of that crew, George Milling-Stanley, a chief gold strategist over at State Street Global Advisors. George, always a pleasure having you in New York City.
Thank you for inviting me.
Well, I know you have to get across to the New York Stock Exchange, so I won't keep you too long, but I was excited to talk to you about the 15th anniversary of the GLD. Right. God, that makes me feel old now.
And it makes me feel older than you, believe me.
Let's talk about the success of the GLD. And really, 15 years sounds like a lot, but it's also not really, right?
Right. I mean, yeah. In the history of the gold market, it's a very, very small span of time, right? But I think that GLD was directional. It was an incredible juncture in the gold market, right? Before November 2004, when we launched, a lot of investors simply ignored gold. They thought it was cumbersome, costly, it was complicated, and they didn't know why they needed it, in spite of all the education that a lot of people like the World Gold Council were trying to do. So once we realized, talk to people who didn't invest in gold and ask, what are the barriers that you see? What prevents you from owning gold? And they talked about the difficulty of storage and insurance and how do you protect it and all kinds of stuff. And we said, well, if we could find a vehicle that would take away all of those issues, that would look after your gold for you and just leave you with exposure to movements in the gold price, would that be something that you might like? And they said, sure, but it's got to be three things. It's got to be a very close proxy for the spot price of gold. That's number one. It's got to be traded on a regulated exchange, like the New York Stock Exchange, for example. And it's got to be 100% secure. People who understood the gold market said we would like it to be an allocated gold as opposed to an unallocated account, right? So individual bars are completely segregated from all of the other gold in the big vault where it's stored.
See, that's really interesting, George, because and that's an important point, is that the audience that's buying gold ETFs versus physical is quite different, right? How often do we see an investor really dabbling in both?
I think it's possible. I mean, I own GLD and I own some gold bars, small bars and coins. The bars and coins are beautiful, and I'm not immune to the visceral appeal of gold, right? I mean, it is a beautiful thing, and these coins I keep them properly, so they're in great condition. But I recognize the convenience of gaining most of my exposure to the gold price through the medium of an ETF, through GLD, because somebody else has to look after the stuff, right? The gold bars and coins that I have are not so big that I would have to include them on my house insurance policy, for example.
And we often talk about how Wall Street doesn't love physical gold. Yep. Do you think ETFs helped gold crack that system a little bit more, make it more mainstream?
I think you put your finger right on it. There's no question about that. If the contribution that GLD and the other ETFs that came to market after us, the contribution that they made was to turn gold from being something that most people thought of as rather difficult, a rather niche investment, if you like, into something that is now mainstream. I think that people are now using the same kind of rigorous analysis for the gold market. Typically they access that through GLD, using the same kind of rigorous analysis that they would for tech or pharma or financials or anything else. And that, I think, is a very, very healthy sign.
What do you see as the next evolution for gold then, right? We had physical, we have ETFs. Is it now the new cryptos we're seeing backed by gold? Is that the next phase?
I'm not sure that we should be looking for a next phase already, because, as you said yourself, we've only been there for 15 years. It may seem like a long time to you and me, but in the greater scheme of things, it's really not a very long period. I don't know what the next phase is going to be. I had a pretty good idea that ETFs were going to be a good idea for the gold market, and I was very supportive of the idea. I'm very happy to work within that field, because to me, marrying the equity market and the commodity markets, which is essentially what GLD did, which nobody had ever done before, that was an amazing thing to get involved in. But the next one, I don't know what the next iteration is going to be.
I was looking at numbers in regards to ETFs, doing my research and knowing you were coming in today, and I was happy you were coming so I could ask you to clarify this. World Gold Council saying that ETF inflows are at record highs that we haven't seen in 3 years. We saw this especially this summer. But last Friday, $620 million was withdrawn from State Street's Spider Gold shares. That's the most we've seen since 2016. So here's the other side of the story with a huge outflow.
Yep.
So what's the real deal?
Okay, let's put all of this into context, including that $620 million outflow that we saw last week. GLD is nevertheless, in terms of assets under management, has grown $5.5 billion in the year to date. That, I think, is important. The smaller vehicle, GLDM, the mini version, has grown $500 million year to date. So it's not a case of these things having turned into negative territory. They're still very, very strongly positive on the year. Now, what happened towards the end of last week, we switched from a risk-off mode for a lot of investors to a risk-on mode. A lot of investors got very excited about the suggestion that maybe the trade wars with China might be over, or might be over soon, or might not be as bad as we all thought they were going to be, or. They were asking themselves those questions. I think that in general there was that sense, we can go back into riskier assets now, so that's why we saw some outflows out of GLD, and that's logical. It's the most liquid vehicle, so it is the one that people can move in and out of easily.
And George, is this also part of the reason that gold has just not done much since September? That there's this, there's less talk of a possible recession. We're seeing more positive economic data come out. So this idea that, hey, perhaps the world's not as risky as it was 3 months ago.
And the Fed is not sounding as dovish as it was the last time they lowered rates. The Fed is now, I think, it's difficult to interpret, but I think what the Fed is trying to persuade the markets, and that's a difficult thing to do, but I think what the Fed is trying to persuade the markets that they shouldn't necessarily be looking for another rate cut in the calendar year 2019. Maybe 2020, but that's something to think about further down the road. So they're sounding just a tad more hawkish than they have for most of the last 3 or 4 months. And again, putting this in context, gold is still up about 13-14% calendar year to date. And I don't think that's too bad a performance. We've broken out of that 6-year trading range, topping out at $1,350 an ounce, which had been there until June of this year. From the spring of 2013 till June of this year, we've broken out of that. And even though we've pulled back a little, we're still decisively above the top of that trading range. I don't think that's too bad a performance.
And that's why I love when you come in studio, George, because you always bring us back down to earth.
Thank you for saying that.
And keep things in perspective for us. Before I let you go, your thoughts on this gold market here?
I think that this is very healthy for a market that had a $200 jump above the top of a trading range that had been in place for a long time. I think maybe gold got a little ahead of itself. So to go back and fill in some of the gaps that the price left when it did that jump at the end of June, beginning of July, I think that that's very healthy. If gold goes back into the territory of the old trading range between 1,150 and 1,350, I don't think that would necessarily be too bad. Because if you think about it, gold opened this century. Let's give it a bit more perspective. Gold opened this century at $250 an ounce, and we're currently about 6 times where that price was at the beginning of this century. I don't think that's too bad a performance either.
How is that for food for thought? George Milling-Stanley, come back anytime. We love having you in studio. I'll let you go ring that bell. How exciting.
Isn't it fun?
Yes.
I'm looking forward to that. And Danielle, it was great to see you again.
Great to see you, George. Thank you for watching. We will have much more for you, so be sure to stay tuned to Kitco.com.